Welcome to another session of audit assurance for professional level. This is chapter 10, audit procedures for specific accounting and auditing issues. This is Jessica Hong, your facilitator for today. Today we are going to cover this topic on non-current asset held for sale. This originated from SFRS International 5. This original standard actually covered both segments, this and another segment called discontinued operations. But today for this session, we're just going to cover non-current asset held for sale. All right, let me just scroll up for the contents. This is the flow that we cover for specific issues. We begin with risk of material misstatements in asset held for sale, and then we will cover the reporting standards, salient features. And before we end the sessions, we will cover audit procedures. Yes, this segment was tested for past year before. All right. So let me just cover the material misstatement. So before this standard was introduced, when we actually have an asset, especially a non-current asset that we intend to sell, there is no special disclosures needed before this standard was introduced. Because at the time there's no reporting standard like this, we find that the financial reporting was a little bit distorted when the board of directors has already passed a resolution to sell a particular non-current asset, which very likely that will take place in the following financial reporting period. Because this decision was made before, but the transaction is only taken place after year end. Most of the time under SFRS International 1-10 subsequent events, it will be reported just as a disclosure item. But what we do not know is that when you have decided to sell a non-current asset, especially if the asset is material, it actually may have an impact on how they can do forecasting for future, because this asset may not be productive by next year because the asset will be disposed. So because of that, for better transparency and also making our financial statement at year end more reliable, this reporting standard was introduced, which requires a non-current asset that has been approved and designated for sale as at year end, we call it held for sale, to be reclassified and separately disclosed. That was the reason. So that is so that we can improve the reliability of the financial statement. To tell you that, hey, this asset I'm going to sell already. By the time you receive the audited financial statement, the asset could be sold already. So this is to improve on the information to be received by the user of financial statement. All right, that is to improve and enhance reliability. So what happened is they given us some guidelines to follow on SFRS International 1-5 on asset held for sale. However, this standard sometimes is not properly observed. All right, and this could be the reason. Sometimes it could be overstated because when you reclassify to current asset, which is expected to be done, they actually expect them to be revised to its fair value or net realizable value, which sometimes not done. Some of them totally forgot about SFRS International 1, this 5. So they did reclassify. They also did inform. They only inform you when it's disposed. So this is also some of the areas that people accountants do not observe. A common reason why asset held for sale is misstated: non-current asset approved for sale and its liability, they will not reclassify to current asset and current liabilities respectively. If you're not very familiar with this reporting standard, just wait for a while. I will explain to you. All right, what is the requirements? The non-current asset held for sale will not remeasured, okay, which is expected to do. So most of the time, even though they reclassify, it's still overstated. Non-current asset held for sale and its liability were not properly adequately disclosed. There was not enough of information explained about this asset that has been reclassified. It did not meet the criteria, which is say for example available for sale, but they went ahead to reclassify. There are group of non-current asset held for sale. They treated as held for sale, which is supposed to be discontinued operations. So discontinued operation will be covered in a separate chapter. All right. So in this particular chapter, I'm not going to cover discontinued operations because we will cover this in a different session. Let's talk about the standards. All right. So generally, when we talk about non-current asset held for sale, it could be an individual asset. It could be also a group of assets. But generally, asset or group assets, these are assets that they do not have the ability to generate its own cash flows. All right. So they are just pieces of assets that you can find in your PPE or your intangible assets. All right. So it can be a group. It can be also a singular asset. The associated liabilities also need to be disposed, because if this asset will be disposed, the liabilities will be settled anyway. All right. Because currently, very likely this asset is used as a collateral for this particular liability too. So because of that, the reclassification need to be done for both if liability is applicable. All right. If there's no liability, then you don't have to reclassify the liability because there's none for you to reclassify. Yes, that's the outstanding amount for the liability. Okay. The standard also requires this group of assets to be presented separately. So they want it to be separately as a line, so you don't combine with the other group of assets under current assets, although it is reclassified. So you need a special line. You need to strictly highlight this asset under this cluster called held for sale. All right. If you have more than one, you can actually group it together and then give a description as a note of disclosure. In particular about this line item, sometimes comparative is nil because you only have it this year. So we actually expect you to explain what is actually inside this asset held for sale in detail in your disclosure. There are some criteria that need to be met. So the standard did specify exactly when this non-current asset held for sale can be used. First thing first, if you want to say you designate asset for sale and board of directors already give the resolution, you must also fulfill these two important criteria. It means that the asset must be available for sale. In other words, you cannot say that, oh, I'm waiting for an asset to come in, swap with this asset. No, cannot. Because it means it's not available for sale. Available for sale means anytime starting tomorrow, if any buyer will want to buy, you can take it. That is called available for sale. All right. But that excludes encumbrance, or we call it use for collateral. Because that one, by the time you sell, if you can settle, you are able to get a good title. So it must be related to other restrictive or limiting factors. Sale must be highly probable. So in this case, you have to obtain all the evidence to demonstrate that, hey, really, we get an agent to come, there are advertisement done, we already get approval, So under that kind of circumstances, you must be able to demonstrate that too. For the sale to be highly probable, all right, so we must collect all the evidence to make this kind of, or the assertions, say for example, to show that the management really committed to sell. So you must collect evidence, say for example, like meeting, approval, getting an agent, the market also follow the market price so that the sale is probable. In this case, when I talk about probable, yeah, it's the next 1 year. All right. And it is unlikely that significant changes to the plan will be made or the plan will be withdrawn. All right. So we need to do some inquiry with the management so that we are pretty sure that this is something that they have approved, they intend to carry out. Okay. So once you reclassify, we actually expect this asset or group of asset to be measured at lower of carrying amount and fair value less cost to sell. So in other words, if the fair value is lower than the carrying amount, you are expected to take a impairment losses and adjust it to fair value less cost to sell. All right. So during the time when it is in that category, it should be continuously reviewed on the fair value. All right. But because we expect to sell within 1 year, so usually the revaluation is not required. All right. But in the following year, if it's earmarked for sale but it's not sale, then you probably want to consider this and see whether is this still relevant or not for us to keep it as non-current asset held for sale. Non-current asset for sale should not be depreciated because once you reclassify and you have mark to market, it will stay at that and you continue to be value at net realizable value or fair value. To test this, first thing first, you need to check whether do we really need to apply non-current asset held for sale, this standard. So that is why confirm first whether it meets the definition or not. There's a few ways for us to obtain some of the evidence. You can discuss. Yeah, that's one of the things. So discuss with management about the availability, ask them what are the plans, what are the things that they have done, take a look at their commitment all the way to get approval. Sometimes some of these tests actually overlaps from one financial reporting period to the next. That's where subsequent events also may actually come in here. All right. You may want to take a look at whether the practical side of selling has also taken place, like getting an agent. Maybe you want to do advertisement, promotion. So honestly, if you take a look, see whether they're making progress or not. Are they expected to actually sell this, or they just say only they want to sell but no action taken? All right. So you need to see how committed they are in this case, so that the reclassification should be done. All right. Sometimes the pricing is also important if the sale should take place. So the selling price that they set, is it close to what has been bid and asked in the market? So we assume that we are able to sell in an open and active market, all right, under these kind of circumstances. So if this has been taken some time, so discuss about the plans, any changes and all that, all right. So you can confirm any outstanding liabilities or not, because the assistant also need to be tested on is associated liabilities, all right. So since we are going to do a revalue, all right, because from carrying value we may adjust to fair value, then we need to do a recomputation just to check on this computation, see whether the fair value is appropriately estimated based on SFRS International 13. All right. If there is actually impairment losses, recompute it just to make sure that the value that we put in as a held for sale is actually accurate. Okay. You can check to see whether they continue to depreciate or not, because you're not supposed to. All right. There's some disclosure for non-current asset held for sale. We do have. So they do actually need to explain that what type of assets that is intended for sale and all these, and they should prescribe their intention and how committed they are. Yeah, they're supposed to do that. So you can take a look at the draft presentation disclosure, see whether is it properly disclosed. Yes, this segment actually tested twice in our past year. So one of the questions is selected for demo. So the demo of this question will be done in our live webinar. All right. So just go through this recording. If you have any question, you can ask me at live webinar. You can send me an email. So for this session, this is a very short one, but most importantly, thank you for listening in. Thank you so much.